banking systems. And they really, really want to harness it because they care a lot about expanding access in their countries to unbanked citizens. And so these regulators, we're finding, are increasingly engaged in the really complex and gnarly issue of tackling the way you could reconfigure the very siloed regulatory frameworks that exist now. You know, each payment, telecommunication, and banking silos, in order to reconfigure that in a way that stimulates access to finance for their poor citizens, but also preserves the integrity and the stability of the system and protects customers at the same time. So there's 6 key issues that I will just merely touch upon, but you can come to us and find out more about, that we find regulators are struggling with as they try to harness mobile banking for the unbanked. First of all, the question of allowing non-bank agents, such as local shops, to offer the cash in and cash out transactions with their customers. Tricky issue. Second, making sure that there's an application of anti-money laundering and countering the financing of terrorism rules are risk-based and pragmatic and don't unduly limit access. Third, figuring out the right regulations on the issuance of e-money and other kinds of stored value instruments. Fourth, making sure that attention is being paid to consumer protection on a whole variety of fronts. Fifth, ensuring that the right design and openness of the payment system is there. And then lastly, looking at really what is the right balance on competition policies, which are anachronistic in most countries, to ensure innovation happens, but that customer-unfriendly monopolies don't arise or persist. So that's how the regulators are looking at this. These 6 key issues that they're trying to tackle to figure out how they can stimulate access but protect customers. Second come the agents. Now clearly we know that the mobile banking in these markets is going to be, of course, a triangle with customers and providers being joined by the merchants that act as the crucial interface between the poor people's electronic value and the cash economy that they live in. And the agents' incentives are, of course, the commissions. But we're actually finding in most places where m-banking is taking off with the unbanked that the commissions aren't really enough to really motivate the agents after a while. And I can go into all kinds of reasons why that is, but just at the very simple level of cost, we find that most of the merchants that are m-banking agents make as much as, say, 10 or 12% on items like toothpaste, but only 1% when they're providing the cash in, cash out for the m-banking transaction. And in fact, the m-banking transaction saddles them with all kinds of other problems like extra security risks and the very serious problem of handling liquidity management. You know, most of these guys, whether they're in the rural areas or the urban areas, are either going to be net takers or net givers of cash. And so that means an awful lot of trips to the bank, which costs money. So far, we've not really figured out the incentives for agents. And one solution may be, and I suspect Ignacio will talk about this shortly, is to devise an operational model for shared agent networks. You know, the same way an agent can sell airtime top-ups for a whole number of providers, why couldn't the same model be used for mobile banking cash in and cash out points? We could get into that later. We're experimenting with this in a couple of places, for example, in the Maldives, that so far have no examples where it's actually worked, because it's going to take a rethinking of everything from bank regulation to business models to commercial strategies. Okay, so the last partner who needs to be motivated to participate is, of course, the poor customers. And we all know that new approaches need to be deployed to reach this frugal and risk-averse new low-income people who may even be illiterate. Really what it means is truly and fully understanding these customers' needs, their biases, cultural issues, the ways they learn. It may not be a menu-based system when they think of how to approach a cell phone. It may be another kind of system. And then apply those learnings to help design pricing, product design, marketing strategies, etc. You know, we've all heard about the cell phones with the flashlight attached to them, which has been very popular in certain areas, or cell phones with the hooks that enable poor people to hang their phone up next to their bed away from what may be water on the floor or in a mud hut. But it's not just about product design, it's also about the software and the marketing, and critically, the pricing. On the pricing front, we found in a recent study we're just in the process of completing, and actually have been working on also with colleagues at Finnmark Trust in South Africa, that there's actually a very key threshold above which poor customers are not willing to go when they spend their money on financial services, and that's 2% of household income. So most poor people can get up to 2%, but they simply can't go above that, which doesn't sound like a lot of money if you're living on, $1 or $2 a day. But we find actually that most of the new pioneers are pricing themselves below 2% of household incomes. 2/3 are roughly below that. And in fact, they're well below the alternative. So far, many are getting it right on the pricing front. I have to mention, though, of course, the biggest success to date in the field of adapting and banking to poor customers, and that is, of course, M-Pesa in Kenya.